In this video, we're going to take a look at a few different ways to measure firm performance. We'll look specifically at accounting profitability, shareholder value creation, economic value creation, and the balanced scorecard. This list is not exhaustive. There are certainly other ways to measure a business's performance. Let's start with accounting profitability, and those accountants amongst you probably are very familiar with this already. But accounting profitability helps to assess competitive advantage by providing essentially standardized information about companies, about their profits relative to their revenues. Um, what's nice is all US-based companies have the same standardized reporting and the same way of preparing these different accounting metrics, so it's easy to compare between companies. And you can easily find the numbers you need to calculate profitability ratios such as ROIC, ROE, ROA, or ROR. Quick side note on that, ROIC, return on invested capital, is the preferred profitability ratio for a strategist because it is not biased by a company's capital structure. Essentially, it doesn't matter how much debt a company takes on because in this class we're looking mostly at operating decisions. We're not looking at finance decisions of a company. The most popular profitability measure using accounting data is ROE, return on equity. ROE is biased by capital structure. It's not my favorite metric, but it is broken down into three constituent parts very easily. These are called the DuPont ratios. You see them here. And these are a little bit more informative and they tell you a bit more about the business. The DuPont ratios aren't the only other metrics aside from ROIC or ROE that are useful. There are a number of different operating efficiency ratios, debt ratios, inventory ratios, liquidity ratios that you can calculate using accounting data. Your book lists a few. You'll see some of them on your quiz this week. And in the simulation, you'll actually be selecting some of the metrics that you will be graded on in this course. So choose wisely and feel free to talk to me if you're confused about how these metrics relate to one another and which are the best measures of different types of performance. So a quick example of how these ratios can be useful when you're comparing two companies. So here we're comparing Apple and Microsoft. You see initially ROIC, so return on invested capital, is higher for Apple than Microsoft. So if you just stop there at ROIC, you'd say Apple is doing better than Microsoft. But as a strategist, you want to dig a little deeper and see what's actually driving performance. So scratch a little deeper than the surface. Why is Apple doing better than Microsoft? Because if you look at the top of these ratios in the green boxes, you see that Apple actually has a much higher cost of goods sold than Microsoft. This is kind of intuitive. Apple produces tangible products, things like computers and phones that cost more money in terms of material, and you have to transport them physically to places, so it's more expensive to produce them, whereas Microsoft primarily manufactures software, which is actually very cheap. You probably are more likely to download a Microsoft product than actually buy a physical product from them. So you would think just on that metric alone, Microsoft should have some advantage over Apple. But then look at these working capital ratios, those second set of green boxes. So fixed asset turnover, inventory turnover, receivables turnover. And you see that across the board, Apple is actually doing better than Microsoft. This tells you that Apple's success is due in large part to their successful management of their working capital. Of course, accounting data does have its flaws. Accounting data is all historical and backward looking, and when you're trying to come up with a strategy for the future, what happened in the past isn't necessarily doomed to repeat itself. Accounting data also doesn't consider certain off-balance sheet items. and it can be manipulated in a number of different ways. It's beyond the scope of this course, but just know that even though the accounting data that all companies report is calculated in a fairly standard way, there are many ways that companies hide bad performance in their numbers, and that's why oftentimes financial analysts prefer to use cash metrics as opposed to accrual accounting metrics to value companies. Accounting data also focuses on tangible assets, which are not the most important, especially in service or knowledge-based industries, where oftentimes intangibles are much more valuable. And it ignores measures of innovation, quality, customer experience, other things that are also very important to the success of a business.